Good afternoon, everyone. Congratulations. You made it to the end. Wow. It's been an incredible day. So give us a second while we're getting set up. I'm just filling a little air time. But as you can tell, Collin and I have been tasked on presenting something. Well, frankly, I'm just the mouthpiece, by the way. Presenting on something that's going to wrap up the full day. But the key is nobody told us how we had to present that. So for those of you that don't know, Collin McGee, you might have seen him in one of our breakout sessions, senior research analyst with the firm. He's been here for 9 years. He covers credit and municipal bonds. He's, well, not only is he a great looking guy, but he's a great guy, and he happens to play guitar very well. So we are going to stretch a little bit here. We're going to try to find a way to take a key theme in markets, and rather than hitting you over the top of the head with more charts and math and diffusion indices, we are going to express concentration and change through song. So Bonnie, by the way, you were wondering what the session was going to be? This is it. So buckle up. All right. So here we go. Let's see. Can we get the slides up on the screen? Okay. We have 2 charts we're going to be presenting. One, I'm sorry, it does have a little bit of math in it. The other one, though, I promise does not. So this is market concentration through time. It's clearly a theme that's important in markets today. It came up with Lizanne this morning. Howard Marks talked about how markets tend to overdo it. Marilyn Rowland was talking about large cap growth. It's the Mag 7. We know it's out there. We know it's important. So as this line is rising on the page, this represents periods of market concentration that are higher, and as it's falling, it represents periods in which it is lower. The other chart we're going to use is literally a billboard chart. So we are going to go back to these periods of time, and the top songs of the day are going to be the way in which we're going to express market sentiment and interest in the time. So let's begin. It's 1964. Coming off the year of 1963, markets are up 23%, so investors are feeling pretty good. At the time, you can see in the chart, again, we're trying to orient with the chart a little bit here, markets are at a recent high in concentration. Not so different from what we see today, maybe to a little lesser degree. The Tokyo Olympics was in 1964. By the way, fun trivia fact, U.S. won the #1, or had the most gold medals that year, except the Soviet Union got the most total medals, so we won't hold it against them. And in February of that year, Ed Sullivan welcomed a few artists onto his show, which is a key to our next song. So now you get the idea and you realize how cool this is really going to be. Okay, so, all right. So we're going to fast forward a little bit in time. It's 1970. Actually, Collin, I can't do this to you. I can't sit up here and drone on about the 1970s and just have you sit there awkwardly. Can you just do a little like background music? Okay, all right, I like that. Okay, 1970s. Market concentration is down. Things have been changing. We had the pullback in 1969. Inflation's rising, unfortunately. It's just over 6%, and unemployment's rising with it. We have the Kent State Massacre, Apollo 13, the loss of Jimi Hendrix and Janis Joplin. It's troubling times. 1973. So markets are up 19% in 1972. Sorry, I had to get over that one. Concentration's rising once again, a little bit more like what we see today. Inflation's down, 3.5. Unemployment's down with it, and the Vietnam War is ending, ushering in a new period of prosperity and fun. Okay. Moving on to the 1980s. This is when Paul Volcker was trying to take over for Robert Burns' mistakes and break the back of inflation. Unemployment's at almost 7.5. Unfortunately, inflation's double that. It's at 14%. John Lennon is assassinated in 1980. Mount St. Helens erupts. It's a time of grit, but grit can also be good. If you remember the Miracle on Ice, the U.S. hockey team beat the Soviet Union at a well they were not favored. They kicked some butt. It's a time of survival. Dear Lord, he's talented. 1999. All right, so we're back to the internet bubble. Markets for the last 5 years have had double-digit returns, 3 of which, I'm going to read these out because they're incredible. 1995, 37%. 1997, 21. And 1990-10, a measly 19, just a mere 19. Market concentration is back to its peak, and frankly, it was at its highest peak until what we've seen today. The tech bubble's in full swing. So you're probably going to wonder, why we stopped at 1999? 2 reasons. One, it was the previous point in market concentration until what we saw from COVID and into today. Markets are still becoming more concentrated. Though primarily, Collin thinks music stinks after 1999. So how do we wrap this up and I get out of the way and Collin can play a little bit more? Concentration is not a new trick for the markets. We've seen it come, we've seen it go, and we don't always precisely know what is going to drive that change. What is the element that creates, new market participants, new leaders? What we do know, though, is as we build portfolios that embrace this fact that change is inevitable, and we build portfolios with your trust that can not just survive through these periods, but perhaps even thrive, it gives us peace of mind in knowing that the future, as it always has, remains uncertain. And so no matter what markets or music, hopefully good music, comes tomorrow, you can be rest assured that the portfolios we design are ready for it. Collin McGee.